I think one of the great ironies of our space is that stablecoins or payments, right, went from the most hated category in crypto. Like 3 years ago, if you said you were working on payments, people would laugh at you, right? This is terrible. This is the graveyard of all crypto startups. To now the hottest possible category. And I think it's, again, this lesson of you've got to be in the water while the wave is coming up.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Simon Taylor. I am your host for today, author at FinTech Brain Food and head of market dev at Tempo. Joining me once again is my friend, the one and only Cuy Sheffield. How are you, sir?
I am great. We got a lot of shows, coming out. I feel like we've been doing them separately. Now we're doing them together. Yeah, it's been a lot of fun. We've got great guests today.
We got some incredible guests. Joining us, making a return, is Haonan Li, the CEO and co-founder of Codex. How are you doing, Haonan?
I'm good, Simon. I'm good at day one of the Mamdani era here in New York City. So excited to see how it plays out.
Wow, yeah, you are there for history. You definitely are living through that. And joining us, making history on their show debut, is Stone Atwine, who's CEO and co-founder of Eversend. How are you doing, Stone?
I'm good, Simon. Thank you very much for having me.
We're excited to have you. Just before we do get into the show content, and my goodness, there's always a lot to get into, I've got to remind everybody that views and opinions of our contributors today are their own and might not reflect those of companies they represent. And please don't take anything we say as tax, legal, financial advice, or any other sort, and do your own research before you do anything risky with financial assets. And I need to remind you, of course, that this episode is brought to you by our friends at Centrifuge. Tokenized is also brought to you by our friends at Centrifuge. Through every crypto cycle, Centrifuge has been building, and today they are the market leader in tokenized real-world assets. Back in 2017, they were one of the first to mint a stablecoin backed by real-world assets with Maker. They're now launched an RWA lending capability with Aave, which is over $1 billion in total value locked. And Centrifuge works with major institutional partners to tokenize and distribute their funds. From treasuries to credit strategies, Centrifuge connects traditional finance to decentralized markets, creating new ways to access and put capital to work. Centrifuge is more than simply part of a tokenization wave. They've been kind of driving it in many, many ways. Whether you're an asset manager or a fintech exploring tokenization or a stablecoin allocator seeking high-quality institutional yield, look no further than Centrifuge. All right, let's start with the first story. I don't know if anybody saw this one, but Ripple acquired a European wallet custody firm, Palisade, and are raising $500 million at a $40 billion valuation. So this is their fourth acquisition this year after buying prime broker Hidden Road, stablecoin infrastructure firm Rail, and corporate treasury management platform G Treasury. And Palisade is a wallet as a service platform, a bit like Dynamic or Turnkey or Privy or one of those sorts of things. And that's going to be baked into Ripple custody, again, a bit like how Fireblocks has Dynamic. I'm going to come to Haonan first on this. A lot of announcements this week. What was most interesting to you about the series of announcements from Ripple coming out of their Swell conference, I believe it was?
I think this is some gigabrain stuff from the Ripple team. I think if you zoom out, what has been the Ripple play has been talk about payments and talk about being the payments chain and hype it all up, have enormous valuation, and then go and buy the substance. I think, there's this kind of elegance to the play. You almost have to admire it.
Do you know, it was Diego Monica a couple of weeks ago said of Ripple, is this the marketing firm that has used M&A to become a real business? And like, part of me wonders, like, okay, but if that's the thing, then that's not incorrect. You can M&A your way into something, and they're sort of full stack here. They've also announced they've done, I think, $95 billion of TPV in that process, and they have a lot of interesting pieces. Stone, your thoughts on this announcement?
Yeah, I think They are definitely doing a wonderful job of using M&A to become a leading player. And I think the main thing that I notice is the attempt to build like an end-to-end stack of everything around payments. They're into custody, treasury, issuance, all under one roof. And this play is very interesting. A one-stop shop for corporates and banks to handle digital assets, stablecoins, and tokenized assets. It's interesting.
Yeah, it's an interesting philosophy of vertical integration or not. Cuy, your thoughts?
It seems like every week on the show there's a Ripple acquisition. It's hard to keep up with the pace of their M&A. I think it's interesting with the Palisades acquisition to think about how custody is evolving in general. And Ripple acquired a company called Mataco a few years ago, and so they have a Ripple custody product. And my understanding is that's been very focused on financial institutions, enabling banks to set up custody within their own on-prem environment. And so that's been the core Mataco product. But it seems much more on the almost like treasury side. If you want to create a ability to hold Bitcoin on behalf of your high net worth customers, like a bank could use Mataco to do that. Now we're seeing this interest in wallet as a service, which kind of serves the other end of the spectrum, where it's much more about how do you embed wallets inside many different applications, and being able to offer self-custodial wallets to end customers, or have very flexible key management. It's much more server-based than it is actually setting something up on-prem. And so we just saw Fireblocks has been a leader in institutional custody tech. They acquired Dynamic, which is more kind of embedded wallet as a service. And so I think that we're seeing more of the demand and the need for this broader range of custody services that can do everything from be a secure way to hold keys behind many different assets, as well as be easily embedded inside applications, as well as be able to offer self-custodial setups. And so it's really interesting, people recognizing if you want to do anything in the space with the stablecoin, it starts with, okay, how are you actually managing the keys? And then being able to play at multiple points across that spectrum seems to be one of the broader trends that's happening.
What's the glass I'm looking at? And how am I instructing the movement of that stablecoin as a customer? And I've had countless conversations in the past week with several different financial institutions, sort of explaining what wallet as a service is and introducing them to this part of the market, because it's how do you take this to your customers is the fundamental question. It's like, all right, I can custody the assets, but then what? Changing my mobile app or changing my online banking is going to take a long time, and I don't want to build all of this stack out. So as a service really, really fits quite nicely. Haonan, I know you've kind of got a lot of connections into Singapore and Asia Pacific. Talk to me about Ripple's kind of presence in that part of the world, and how significant a player they are or are not when it comes to some of this stuff.
I think Ripple's name comes up, but I think, to speak candidly, I think it comes up more in conferences than in market. I think you're seeing Ripple transform, right? Ripple went from this fantastic business, which is a infinity gross margin business. It's called sell a token and sell a dream. And then now they're moving into really doing payment ops. And so in a sense, I guess their margin will compress. But I think it's good, right? They're working on real substance. And if they integrate all this stuff, I think they'll be a really formidable competitor.
The Fortress Investment Group, Citadel Securities, Pantera Capital, Galaxy Digital, Brevin Howard, and Marshall Wallace are the investor group here. That's heavy hitters. Haonan, I know you've sort of worked with similar categories of investor. What is it they look for when they're evaluating something like this?
I think there's this anxiety in traditional finance that their Corinthian columns will not save them. That even though they have these big buildings and this incumbent position, that they're in the midst of a platform shift that will leave them behind. And I think when you feel like that, people start throwing money at things in hopes of getting some corporate Xanax of sorts. So I think there's an aspect of that going on here, right? And I think they certainly look for a team with the expertise to focus on stablecoins. I think one of the great ironies of our space is that stablecoins or payments, right, went from the most hated category in crypto. Like 3 years ago, if you said you were working on payments, people would laugh at you, right? This is terrible. This is the graveyard of all crypto startups. To now the hottest possible category. And I think it's, again, this lesson of you've got to be in the water while the wave is coming up.
Mm-hmm. Stone, your thoughts on sort of some of the investors here, or sort of some of the market perception shifts that Haonan was talking about that?
Yeah, I think that there's a real shift from speculative tokens to real use cases now, and these investors, including the potential customers of Ripple, the banks and the corporates they are looking at, now on top of the pressure of being moving away from traditional payments as is, there's real confidence in institutional regulated rails, and Ripple has noticed this. That's why they're buying everything that's necessary. And I think going away from just looking at XRP as tokens is a massive narrative shift. So payments, treasury, tokenization now is replacing crypto trading and those tokens that they were building. So I think at the end of the day, it's a good thing. And Ripple has really been trying this for a very long time. They've been trying to go into payments. It never really happened properly, but using M&A is a very good way for them to actually jump in and get moving and at the right time.
I was just going to say, it'll be interesting to see how Ripple equity versus XRP are perceived over a longer term period. And XRP, I think fully diluted valuation's $220 billion, and now Ripple equity raising at 40 billion. I don't know exactly how much of XRP Ripple owns, and so then it's are they going to go public in the future? And is it kind of like one of these digital asset treasury companies where you have a business that's making money in payments, and then you also hold a lot of XRP on the balance sheet? And as we talked about on the show, what's going to be the connection between the two? Is RLUSD going to run more on XRP Ledger, and then is that going to drive demand for XRP? But today RLUSD is more on Ethereum, and so if RLUSD grows on Ethereum or the other businesses that they have on other chains, how does that get back to XRP? So it's just going to be really interesting to see this play out. And I think in the future, there will be multiple examples of public companies that also have public tokens that trade separately from the equity. And we'll see how those end up being viewed. And is there going to be a retail investor run of the same people who buy XRP are now going to buy Ripple stock? And it's hard to really reconcile those two together still.
It's a new part of the capital structure. It's a brand new part of the capital structure, right? They got to update all the textbooks. You've got junior debt, senior debt, equity. Now you got tokens, and you're going to figure out all this sort of cross capital structure arbitrage out over time.
Well, and I think the point here is, there is a precedent now that there was the case won against the SEC, and that has set a precedent of XRP in that legal proceeding was not deemed as security in so far as it got. And I think that sort of changed the perception of Ripple to a lot of folks in digital assets and crypto more broadly of okay, this is an organization and a token that is here to stay. And then in the things that have happened since, like the Genius Act and a lot of the announcements from US regulators, tokens appear here to stay. Then we had the digital asset treasury boom. So that is a really interesting question of where that fits with the business. These two things almost feel still somewhat disconnected. To Cuy's point, I don't know where RLUSD hits the Ripple ledger, and I don't know where G Treasury hits RLUSD, which hits the custody business, which hits the wallet as a service business. These things feel somewhat disparate. And as a payments veteran, I always used to joke about certain payments companies being like three kids in a trench coat. And that's always the risk, like trying to be an adult. That's always the risk with M&A. But there are companies that have pulled it off. Like if you go look at Meta, Instagram and WhatsApp were greatest, GOAT acquisitions. Google with DoubleClick and Google Maps and Android. Like you can do this extremely well, and maybe that integration is just really an execution risk question. So I'm really hoping to see some coherence in that strategy. I want to bring us to the next piece I picked up this week was there was a roundtable discussion at the Future Investment Initiative event. And it featured sort of Jamie Dimon and Larry Fink talking tokenization. Well, it finally happened. Dimon said, crypto is real, stablecoins are real. Haonan, how did you feel about that? Is that responding to client pressure? What were your thoughts when that happened?
I think he pulls off the dignified capitulation very well. I'm not sure I would be able to pull it off quite so well. Jamie's obviously a enormously talented and brilliant man, and he's always sort of been, highly skeptical of maybe the crypto product market fit. And it's great to see somebody so prominent really see reason.
It does feel like a watershed moment's done. And the other thing that happened is Larry Fink saying, I think he was asked quite an open question by the interviewer, who said, we are not spending enough time talking about how quickly we are going to tokenize every asset. And what does that mean for the role of the dollar? What does that mean for the role of bank payments? And what does that mean for the payments companies? Have you spent some time thinking about those topics, and where do you think the important answers to the role of the dollar or bank payments or payments companies starts to come in?
Yeah, I think I look at it like separately, and I think obviously these guys are not sleeping. They're always thinking about this, especially the existential threat of their traditional businesses as they stand. But I look at stablecoins more like the solution to improve better payment rails, and tokenized assets will be very, very interesting, where they try to put everything on chain, probably do a lot of yield on top of that. And what they're trying to do is to turn the rails that are upcoming into real business for themselves, especially with some of the emerging markets where this is working really well. So I think they are thinking of using payment stablecoins to move value and tokenize assets to store and grow that value. But at the end of the day, I think it will not matter, and they will do a good job, because most of the users will not be able to see the pipes in the background, but these guys are not playing around. They will still be better, faster, cheaper. Like Haonan said, it's capitulation, but still emerging as big players in the space, obviously, because of the amount of payments and asset management that they're already involved in.
It's interesting to just think about like where this interplay between tokenized assets and stablecoins goes, and like what are the connections between the two, and like will this be a flywheel where like one accelerates the other? And so my very simple model for this is, I think about almost like three ways. One, you have tokenized treasuries becoming more and more the reserve backing for stablecoins. We're seeing some of the protocols, shout out to M0 and that team, that they're using on-chain collateral for the reserves to then be able to see, okay, this stablecoin is backed by I think it's Superstate as one of the tokenized assets. Then you have the ability to say, okay, can stablecoins enable 24/7 trading of tokenized assets? And what's the benefit there, and being able across the world to get access to a tokenized version of Apple stock or some fund that you can then trade in real time with the stablecoin. I think that's interesting, and BlackRock talks about the benefits there. And then the one I think is most interesting is tokenized assets as collateral, to be able to use in a smart contract to be able to borrow, and being able to have stablecoins as the way that those loans are dispersed. And so I think once you can represent many different types of assets on chain, what can you actually do with them? And it seems to me the most interesting thing you can do with them is actually be able to use them as collateral and create new types of credit markets with those assets. And so I could see this world where like stablecoins have already hit escape velocity. Tokenized real world assets are much kind of lower in terms of was it a few $billions in terms of the total market cap, but they will continue to come closer together and interact with each other. And I think BlackRock is has obviously been really at the center from a mainstream large financial institution that's trying to drive this intersection.
And I think both of them have customers that are demanding this product increasingly. JP Morgan is not custodying digital assets, but it has been settling payments for Bitcoin trades for quite some time. So if a big enough customer, even if they're a crypto native institution, wants something, they will do it. Similarly, BlackRock's BUIDL is used by some of the largest institutional customers. But both of these companies are the classic economies of scale businesses. For them, sort of a slightly more efficient cross-border payment than retail gets is nothing. If they're charging 1 basis point on an FX transaction, still 99% margin. Like they have such wild economies of scale that getting into tokenized real-world assets needs that scale. But if there's a customer willing to pay them at a different rate that wants tokens, then hey, let's go do that. And I think what's happened is with stablecoins and some of the regulatory clarity, the business case is getting better and better and better as time passes. And JP Morgan in particular has invested for half a decade into Connexus, has multiple products in there, has done JPMD. And so now when the client demand hits the product you can sell, this becomes a different conversation to, do I like Bitcoin or not? It's a conversation about, do I like this business that is much bigger than Bitcoin, yes or no? Haonan, I'm interested in your views of like who the next adopter is of tokenized real world assets. I know payments are kind of your bag, but is it the growth in crypto native institutions? Is it people who happen to use stablecoins? Like, where's that real world asset growth gonna start to come from?
Yeah, we're spending our R&D efforts and really thinking at the frontier of stablecoins RWA is, what are new assets you can build that previously were not possible? I think that's what excites me the most. I think the kind of stick an old asset on chain thing is great, and more distribution, fantastic, has a lot of upside. But what are the de novo assets that are now possible? And I think if you think about a company on using stablecoin rails, you could effectively create this sort of super first lien type credit instrument where for each incremental new dollar that comes into that corporate, it pays down the debt first. And thinking about kind of the risk mitigation that can create across the emerging world, and thinking about kind of the new types of credit flows that are possible when you are able to mitigate risk like this, gets us very, very excited.
Yeah, Cuy, you've been talking about streaming money or flowing money for a little while. Have you seen that catch fire in any real world use cases, or is that something that is still to be proven? I know it's an idea that's intellectually very, very interesting to you, but what would be the conditions to kind of make that happen?
Yeah, I think it's still very theoretical today, but to me, when in the context of I look at it with things like Visa settlement, where the way that the traditional financial system and payments work today, it's almost like it's a clock. So you have this very mechanical, you have a settlement time that happens. When it hits that time, money moves, and so you've got authorizations that are streaming and happening 24/7. Those are then creating these settlement positions. A settlement report goes out, and then the clock turns, and then all the money moves. And so it's really interesting to think about the way that money flows, from a messaging standpoint and authorization standpoint, could you also have settlement, at the same time, where you could actually move the money, end to end through the network, and it's more streaming rather than it is this kind of mechanical clock function. But there are a bunch of questions and challenges when you have systems that have been built over decades, where you didn't even have the rails that made that possible. The only option was to move money, once a day. And then, it's also when you talk to corporate, treasury folks, there are also these efficiencies from only moving money, once a day. When you think about things like net settlement, when you don't actually have to move the money. And so I think there's still this question of how do you reconcile the really cool, innovative, future-thinking things that these rails can do, like you can technically move money, streaming per second, with the just economic efficiencies and realities of, well, isn't it better not to move the money at all if you can batch together and be able to net settle? And I think that's like the really interesting, problem set and question of like, where does it make sense to stream? Where does it make sense to net settle? What can you do once the money gets there? And we like barely scratch the surface as an industry on like, how to find that right balance. Stone, I'm curious how Stone, how you think about that, and like you've started moving stablecoins from like a corporate treasury perspective. Like, do you move on the same settlement cycle of like what you normally do? Like, where do you find that balance?
Yeah, you raised a very interesting point because we used to do a lot of netting, and now it could actually get expensive to settle every transaction in real time, although it's much more efficient because it takes away the ability to net off. But I think there's examples of ways to really take advantage of this. And the way I look at stablecoins really is to kind of play with the easiest or the most efficient use cases. So we're always talking about, cross-border payments. I look at it in terms of collections. So one of the things we're looking at is very, very simple use cases, nothing fancy. Speak to, let's say, Stripe or any PSPs that are collecting money out of Africa and get them to collect from their African users in local currency, and we can settle them instantly using a stablecoin. In those one direction flows where OpenAI or Spotify or any of these global companies don't need to pay money back into Africa, this is a very good use case. But when you talk about like the visa settlement, that's a whole different angle because it's a bigger thing that has been built over years and is very efficient. The netting off is very, very important and saves a lot of cost. So the way I look at it is to see where it goes, but kind of focus on use cases where there's massive value. So like one direction collections, one direction payments, a company that is in, let's say, here in London and sends money to Nigeria or India, but that has no presence in India or Nigeria to send money back. That would be fantastic because then we can allow them to make payments into Africa, one transaction at a time, that they can settle to us as soon as they send the transaction. We deliver into M-Pesa or into a Nigerian bank account, and they settle us with USDC or any other stablecoin. I think for me, I'm not spending too much time thinking so hard about the complicated use cases. I'm looking more at the easier things where these stablecoins and produce massive value today, and then we see where it goes.
That's a great point. I was having a conversation earlier today with somebody who was describing, kind of the scale they operate at and netting that they have, where there's a ton of value. But they also described the unidirectional payments being the thing that's really clear. And I loved how you framed that because I also think about the corporate treasury use case. It's most useful to somebody like a dLocal or a Flywire where they have an imbalance of one sort of payment or another. So yes, they could be doing netting, but when the netting doesn't net, when the balances aren't equal, that's when I need a unidirectional payment, and that's when stablecoins are valuable. And so I can't get the netting efficiency from that type of payment if I don't have those currencies in those places. Now, it makes a ton of sense. I love that mental model and frame of thinking about things, because Cuy, you and I have both spoken to a chap recently who had that idea of financial compression, which I thought was such a nice way of thinking about what it is netting does and what it is CLS does. They take all of this sort of sets of ways of making payments, and instead of doing it gross, they net it. And instead of doing netting, you'll do an in-house bank, and then you have these industry ways of doing it. But there are flows of payments where those forms of financial compression are not available, and that's where stablecoins have made a difference. What a wonderful way to leave this thoughts. Haonan, any other thoughts on these topics?
No, these are the nuanced industry takes that you can only find on Tokenized and not other general industry podcasts.
We're payments nerds through and through. You get a guy from Visa and a guy who's worked in payments for 20 years, and we invite equally nerdy folks to have a chat. Well, before we move on, I do want to just thank our sponsors. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Stripe. Stablecoins are the building block for borderless financial services, making money move around the world as easily as data. With Stripe, you can use stablecoins and crypto to reach untapped customers, reduce cross-border fees, and settle payments in minutes instead of days. Best of all, it works the same way other Stripe products do, by API or right inside the Stripe dashboard, meaning you don't have to worry about the intricacies of which blockchain or what wallet to use. From Shopify to Vercel, global businesses trust Stripe's complete crypto solutions to unlock new markets and reach more customers. Borderless finance built on Stripe. Learn more at stripe.com/crypto. Thank you so much to our sponsors. The next story I had was Securitize are going to go public via a SPAC deal at $1.25 billion valuation. The CEO said tokenization is what everybody's talking about, but there's nobody publicly traded that does it. We will do it well in the public markets because people want to index themselves to tokenization in the same way that people are buying Circle because they want to index themselves to stablecoins. So Securitize is kind of an interesting business that's been tokenizing real-world assets for quite some time and has been trying to get that done. But I want to see that there's more here than just a timing thing. Cuy, have you come across Securitize before? Have you seen them in the past? Had you looked at this story?
Yeah, first, shout out to Carlos in the team. I mean, they've been building in the space for a long time, and I think this is what we see over and over again. That it's the teams and the founders that in the bear market in 2022, 2023, nobody cared about tokenized real world assets right after FTX blew up, and Securitize was just continuing to plug away around how do you do this in a regulated, compliant manner. And so I think it was a major inflection point when BUIDL launched, and Securitize powers and partnered with BlackRock for that product, and I think that really put them on the map, and I think accelerated the growth of the whole industry, and I think they've become one of the leading players in it, and so really excited to see this. I'd love to see. I don't know the details of are they going to tokenize their own equity, and we've seen other firms like Galaxy. I think Galaxy Digital has a tokenized version of equity that they're doing with Superstate. So I'm really excited for that. Of if you're a company where your business, is in the tokenization space and you're going public, like you got to eat your own dog food and figure out what's the best way, that your equity can be available on chain. So I'm interested how that plays out.
They did say they're going to do that. So yes, I would fully expect them to do it. But of course, it's sort of slightly tangential, but the DTCC and NASDAQ have announced they're going to tokenize any stock that's held in the DTCC, and when that's going to happen, don't know. But it's a work in progress, and I think that's why there's this sort of confidence of tokenization is a wave that's coming. We don't know specifically when, but the DTCC is another one that I did my first piece of work with those guys in 2016, and back then they were mature on this topic, but the infrastructure wasn't. That has meaningfully changed now. I think the infrastructure is in a very different position, and they're trying to be sort of supporting the market. And Securitize has tokenized more than $4 billion in assets. They have 550,000 investor accounts, and alongside the Biddle Fund, they've also tokenized Hamilton Lane's Senior Credit Opportunities Fund. So this is an evergreen private credit fund that you can buy into with a minimum investment of $10,000. There's also the VanEck Treasury Fund, which is a minimum investment of $100,000. So, these are small numbers compared to the overall capital markets world, but they're good proof of concept. Do you think, Stone, that this type of thing is going to catch fire soon? What are going to be the things that make sense? Is it in the payment space for your own business? Are you seeing corporate treasurers want to get access to this type of stuff?
Yeah, I think there's a bit of hesitation, but when it takes off, it's just going to be fire. I think we've been singing tokenization for a very long time. So my thinking is it's going to just be all at once. Although there might be some initial hesitation, some people are still hesitant a little bit. But yes, that's what I believe in. Going back to what you mentioned, I think trying to do this SPAC, I think, is a brilliant idea for them, because you can see from Circle that the public market has massive appetite for tokenization, for stablecoins, for stablecoin infrastructure, and it's shifting. Any company that could SPAC, I think this is an amazing time for them, because capital will definitely flow into these businesses aggressively.
Fascinating stuff. Haonan, do you think it's going to be that? It's going to be that sort of space where it really catches on? And do you have a crystal ball in front of you? Do you have like a time horizon in mind for some of this stuff?
I think this reveals a lot of narrative violations, right? So first is the idea, at least one idea of why tokenization is a good idea, is that, more people can access the asset. It will allow a larger buyer base and so on and so forth. And certainly operational efficiencies are real as well. But a tokenization company is choosing to go public on traditional markets. It's a very interesting phenomenon. I think if you observe what's happened with altcoins this cycle, they really haven't had a pump, right? Altcoins really haven't had a pump. Instead, the pump has happened in the public markets with Circle stock and other places. And so it's interesting. It's interesting to see these worlds collide and old sort of assumptions be challenged by a new empirical reality.
The narrative violation is an interesting thread to pull on. It does certainly seem like institutions are a much bigger part of this story, and they have and probably could be for a good while yet to come. But I want to come back to Cuy on this story, because I know I've certainly spoken to a lot of folks who are looking at where they think about risk in this space and whether they should get involved in it and whether the time is now. You've said that you still think that over 6 months, not a lot will change. Over 3 years, everything will change. Is that still where your view is here?
I think in general, when you talk to large financial institutions, you talk to large enterprises, like it's clearly shifted from like curiosity, to like execution. And so we kind of went from like disinterest, I don't care, maybe this all is going to go away, to all right, like this is going to stay. We need to come up with a strategy. And, we said 1,000 times on the show, every bank needs a stablecoin strategy, and like just repeated it over and over. And then I think eventually most people said, all right, like we need a strategy. And I think now we're starting to go from, all right, like we've been spending the past few months on this. We've got a team, we've got some people in place. Like, how do we start to execute that strategy? Now, if you're a bank, if you're an enterprise, executing a strategy is not a thing that happens in a few months. You need to figure out, okay, who are the right partners? How do we onboard them? There's still a lot of people. I think what I found is even if there's top-down support in an organization where, I think that's like, critical to get anything done in a large company is, anything new, there has to be top-down support. There's still a ton of work in educating, people in between around how does this work? How do you mitigate the risks? Who are the right vendors? How do you onboard those vendors? How do you structure legal agreements with those vendors? What happens when something goes wrong? So there are all of these things that have to go through, and I think in 2026 you'll start to see more like early stage pilots that start to come out from larger institutions, but I don't think you'll see many scaled products until 2027, 2028. Just it takes time for any kind of brand new technology to be integrated into the core offerings.
With one possible exception, I do see a lot of buy, sell, hold. Sort of what the Revoluts and the new banks were doing 5 years ago. That as a feature is now available in BBVA. It's available in Santander. So that's become like table stakes, I think, for the financial institutions. But that point on risk is so key. I'm sure, Haonan, you saw with interest that the USDX synthetic stablecoin depegged below 60 cents and sort of caused a bit of a hubbub on X. But
can you explain that? Like this is something that I read multiple threads on USDX, and it was like reading another language of the number of things happening there. They're like, I could not explain it. Like, is there a like very simple explain to me like I'm 5 what happened with USDX?
I honestly have been pretty heads down on business. I'm not super read up on it. My guess would be it's like layered counterparty risk on layered counterparty risk on layered counterparty risk.
Bullseye. So it's rehypothecation. Like there's no way you get 92% APY without rehypothecation. So I will lend. I get a receipt for having sort of parked collateral inside of a DeFi vault. I then use that receipt and I park it into a different DeFi vault. And then I get a receipt from that and I park it into a different DeFi vault. And it's sort of all the way down sets of counterparty risk. So I'm just leveraging up my risk. And if any one of those pieces kind of comes in. Now, I don't know what specifically seems to have triggered this. So I'm still trying to read up on it. My point was that to the point about risk management, I wondered, this is obviously quite a small thing, but one, it calls itself a stablecoin. And actually it's not. It's sort of a high risk, high yield instrument. And two, USDX, it sounds like a stable coin. There's that sort of parlance of like having the letter at the end. And then there's the perception in institutions. I mean, Terra Luna and FTX were the like drop the business case, stop doing pilots, no more PR, fire the innovation team that was working on it moment. And I worry about that happening this cycle, but it happening on the institutional side. Stone, were you any closer to this? Did you see what happened here?
No. But it's definitely, it sounds, from the way you explained it, it's definitely a recipe for disaster.
I have a take here. So I think people's perceptions of stablecoin risks are reasonably well calibrated because they have the scar tissue from Terra Luna and so on and so forth. I think where risk perceptions are tremendously miscalibrated are actually in traditional financial markets. First, when it comes to the S&P, which historically has been heavily weighted towards tech companies that are low in capital intensity, that have no real marginal cost and can kind of grow into infinity. we're seeing a transformation of those businesses that are now becoming capital intensive in the AI era and that have positive marginal cost per incremental user. I'm not sure that's fully understood when people are YOLOing into S&P. That, $5 out of every 10 is going towards this one correlated bet that could play out or not. I think the second area of miscalibrated risk would be in private equity and private credit. There's a danger here, which is this democratization sales pitch is really cover for finding the next bag holder. When Kravis was doing LBOs way back in the day, retail had no access to that. Why? Because he was making too much money. He was hand over fist. Now that private equity can barely get LPs put in new money, when Yale is selling private equity stakes as fast as they can, now retail is being offered this wonderful opportunity to participate in private equity investments. Why is that the case? I think we should be very, very careful about this. And to the extent that us as an industry enable this through this kind of tokenization sub-thesis, we should be very careful.
Indeed, risk is risk, no matter where it comes from. I also saw with interest this week that Robinhood, in their earnings release, were quite cautious on adopting Bitcoin in its corporate treasury, questioning whether it was the best use of their capital in quite a bit of a different position to the likes of the digital asset treasury firms and Michael Saylor. But their crypto revenue rose 300% to $268 million in the third quarter, which was kind of less than 20% of their overall revenue. So it's a meaningful part of their business, but not the only part of the business. On the digital asset treasury space and that sort of move to the public markets, I think you have got an interesting thesis there, Haonan, and somebody that's as sort of aggressively pro tokenization as Robinhood, not choosing an asset like that in its treasury, I guess speaks to the difference between capital allocation and prudent risk management versus crowding into a religious asset. I see those two as being different things.
It's interesting that it seems like last cycle there were more stories of corporates who had a business unrelated to Bitcoin buying Bitcoin in their treasury, and what Tesla was the largest one. I think there were a few others. We haven't really heard that nearly as much. It's like there are these very specialized digital asset treasury companies where that's the whole purpose of the company is to try and stack Bitcoin, but there's no really other business as a part of it. But I just haven't really seen that. Stone, do you see Bitcoin as a treasury asset at all in the markets that you operate in, or is it just it's stablecoins that people in emerging markets, companies actually want to hold stablecoins on their balance sheet? They're not looking to hold Bitcoin or any other type of crypto asset.
I think apart from at least what we see in Africa and other emerging markets is most there's interest in Bitcoin and all these other tokens from some retail players. So there's speculation there, but corporates definitely not interested at all. I couldn't tell you of one person I know, one company I know in Africa that is holding Bitcoin on their balance sheet or at all. So people are more interested in the efficiencies, of stablecoins, and I think Robinhood is a great example. What we were saying about a company that is actually involved in crypto trading, has massive crypto revenue, but is hesitant to have his assets, to have Bitcoin on their balance sheet. I think that's kind of the right way to play with corporate treasury. And it's important that most of these businesses look at the risk that's possible with Bitcoin. And anyone who is serious about risk will be careful. I think individuals can play this game all they want, but corporate organizations are very careful. Even in our case, we do a daily, our daily treasury management involves making sure we don't have a lot of exposure to these assets. So we will only hold customers' Bitcoin the way it's supposed to be held. Then we will hold maybe like 3% of our own assets just as a buffer. But and I mean we've been hacked before, so we are very careful. We're doing daily rebalancing and treasury management to make sure that the exposure is not too big.
Yeah, don't make the prize pool too big. It's funny how just how many challenges there are still in the digital asset space, and you can see where the institutions are right to take their time. We given the scale that they're operating at, but also, it feels like this is the first show in a while where we've sort of been sort of anti-bullish on stablecoins or tokenized real-world assets, because the job has moved from explaining the opportunity, because I think that's now largely understood, to explaining how not to get it wrong when you do enter, and explaining the risks and sort of living in that space, which is an important shift. It's the less exciting person works hard phase of the cycle, which is a good thing to have. Well, listen, gents, I don't know if you guys had any other comments. If not, they are coming close on time. I want to thank everybody for participating today, everybody for watching and listening. Haonan, if people want to learn more about Codex and what you're up to, how do they find you and how do they find Codex?
Yeah, I'm on Twitter at Haonan, Haonan.
Stone, how about you?
Yeah, I'm on Twitter as Stone Atwine or Stone Atwine, like everybody reads my name. Yeah, and with Eversend, we're really trying to build very solid liquidity regulation backed stablecoin rails to help payments in emerging markets. So if anybody is interested, that's kind of our play.
Excellent. Cuy, how about you?
On X at Cuy Sheffield and visa.com/crypto.
You'll find me on the socials at SY Taylor. You'll find me at fintechbrainfood.com, ranting into the void about stablecoins or something along those lines, and tempo.xyz. And if you haven't already, please hit like buttons, subscribe buttons, leave reviews, comments, and all of the things that hosts are supposed to ask you to do. And more than anything, spam everybody you know about how important it is they listen to this esoteric, industry-focused podcast about tokenized real-world assets and stablecoins. Because if you're into this sort of thing, we get unusually weird about that sort of thing. So please join us and bring others too. Thank you so much, and we'll catch you soon.